Hey everybody, Austin Lieberman here. This channel is different than other channels you watch on YouTube. I actually talk about how and show you how my own portfolio, my own money is invested very transparently. I'm going to share my entire portfolio at the end. And then I talk about evaluating stocks and thinking about what prices they could be and should be trading at, and if they look over or undervalued. If you've watched this channel, you know I have owned CrowdStrike in the past. I do not own shares right now. But they just reported earnings and they were actually better than what analysts were expecting. And their guidance was a little bit better than what analysts were expecting, which is very different than what we've been seeing from a lot of cloud companies and software as a service style companies that have come out and actually showed a slowdown in growth moving forward and lowered their guidance. I think this is because we're in an age of cybersecurity threats with everything going on with Russia and Ukraine and just all different nation state and non-nation state actors, and hackers, just more and more hackers out there, right? Cybersecurity is a booming industry, right? But that doesn't mean that CrowdStrike is a buy right now. So we're also going to look at that, and we're going to look at growth expectations and how the stock is currently valued and what that means going forward. So let's talk about the earnings. CrowdStrike shares surge 7% as Outlook earnings come on strong. You can see it's up about 7% after hours. And you can see over the last year, the stock is down from traded as high as 223 in April of 2023 or 2022, and it's down to 127. Still down quite a bit, but over the last year to date, the stock is actually up pretty nicely. So rebounding a little bit, right? Okay, let's get into the quarter. The cybersecurity technology company forecasting upbeat revenue growth on the heels of better than expected fourth quarter earnings reports. For its fiscal first quarter, CrowdStrike estimates it will earn between 50 cents and 51 cents a share on revenue in range of 674.9 million to 678 million. That outlook came along with CrowdStrike reporting a fourth quarter profit of 47 cents a share on revenue of 637 million. Analysts had forecast CrowdStrike to earn 43 cents a share, so they beat that on revenue of 626 million. So they beat revenue by about $9 million, $11 million this quarter. During the same period a year ago, CrowdStrike earned 30 cents a share, excluding one-time items, on revenue of 405 million. Company added 222 million in annual recurring revenue during the quarter to end its fiscal year with an annual recurring revenue of $2.56 billion. And so, from last year, 405 million to this year, 630 million, that's over 50% growth. So very, very strong revenue growth right there. Company said it added 1,873 new subscription customers, giving it 23,000 subscription customers. They specialize in machine learning for its cybersecurity technology products that are used to detect malware on devices that use corporate networks. All right, so let's get into how their guidance looked compared to what was expected. Company issues upside guidance for Q1, sees earnings per share of 50 cents to 51 cents versus 43-cent S&P Capital IQ consensus, so beating the consensus. Sees Q1 revenue of 674.9 to 678. We talked about that versus 666. So beating revenue guidance by anywhere from $8 to $12 million, depending on where they come in. They issued guidance for the whole year, fiscal year 2024, earnings per share of 221 to 239 versus 201. So beating analyst expectations by anywhere from 10 to 20% on earnings growth, which is fantastic. And then they see fiscal year 24 revenue of 2.955 billion to about 3 billion versus 2.99 billion consensus. So it looks like they're expecting a slowdown in the back half of fiscal year 2024. If we look at the strength of that Q1 guidance number and how much they're beating analyst expectations by, but then they're barely beating analyst expectations when it comes to, and they could even come in below analyst expectations for full year revenue, of about 3 billion. That was analyst expectations, but they're looking to be a lot more efficient and have a much higher earnings per share than what analysts were expecting, meaning they're getting more efficient. They're getting closer to profitability, right? Okay. Let's think about how the shares are valued today and at what prices they'd be a buy. So what I'm going to do is something very simple here. These are analyst expectations that are in that S&P Capital IQ database. That's where the database of all the Wall Street analyst expectations go. It's a huge database. That's where all these numbers are pulled from, right? And I'm going to put them into this 5 and 10 year scenario. We're going to see just where we would buy the stock based on how these scenarios could play out, right? It's just estimates, right? Very basic estimates. We need to do deeper research if we're actually going to own a stock. So over the next through 2027, analysts are expecting compound annual growth rate of revenue of 33%. They are expecting net income in 2027, the net income margin, profit margin to be 24%, and then the free cash flow margin to be 31%. So what we can do is we can take those numbers and we can come up with a low, a medium, and a high assumption. We're going to start at 5 years and then we'll go out to 10. So we're going to put 33% in the mid. And then again, we're going to do net income margin 24% and free cash flow margin of, we'll call it 32%, right? So 24% profit margin. And I think we said 32% free cash flow margin. That's the middle scenario. I want to go 20% below the mid scenario, which would be revenue growth of about, we'll call it 6 below, we'll call it 27%. And then we'll go a profit margin of 20%. That's about 20% below. And then we'll call it 26%, 27% for free cash flow margin on the low. And we'll go about 10% higher on the high side, right? Just be a little bit conservative. So we'll go 36%. We'll go 26% profit margin. And then we'll go 35% free cash flow margin. And the PE is going to be the thing that is really tough to know here, right? I mean, we're going 5 years from now. Let's call it a middle PE of 50. This is a tough one. We'll go a low PE of 40. Actually, let's dial that back, right? Let's go 40. We'll go 30 and we'll go 50. And then we'll go, we'll keep it basically the same for price free cash flow, 30, 40, 50. And then we're looking for 12% return on the low scenario. We'll go 14% annual return and then 16% annual return for the high scenario. I'm going to hit analyze and it's going to tell us where you would buy the stock right now based on these 3 potential situations. We'll call that a bearish, a base, and a bullish case. If you're looking at the next 5 years, hit analyze. I don't even know how this is going to come out. So, okay. So here you go. Based on these assumptions, you would buy the stock at, basically, I mean, it would be a buy right now, right? It's at 130 for the current price. And the middle scenario, you'd be a buyer at 197, right? Now, the biggest, I think, criticism of this could be the PE ratio, right? I mean, you've got Google and Meta and different companies with, great business models trading at much lower PE ratios. So let's be more conservative with this. And I'm not saying that I agree one way or the other necessarily. I'm just trying to paint you a picture of what needs to happen for this to either make money or not make money, right? Just trying to give you a fair idea. Okay, now you have room all the way down to a PE of 30, and we'll keep the price free cash flow. We'll keep these the same too. 40. Okay. So now you're starting to see the low scenario with revenue growth of 27%, profit margin of 20%, and free cash flow margin of 27%, and a PE of 20, price free cash flow of 20, and a desired annual return of 12%. Well, now the stock is overvalued if you believe that scenario to be true 5 years from now. If you believe the middle scenario, 33% revenue growth, 24% profit margin, 32% free cash flow margin, a PE of 30, and a price free cash flow of 30, then you're looking at $152 share prices where you could buy it under today to get a 14% annualized return, right? Now, we're making big assumptions here. We're making assumptions that free cash flow margin improves drastically, and so does profit margin. Because look, over the last year, profit margin was at minus 8.7%, and free cash flow margin was at 29%. So let's bring that down, and let's bring the profit margin down to we'll say 20% for this scenario as well. And then in the high scenario, we'll still keep the high scenario. We'll go 24 profit margin, and we'll go a free cash flow margin of 30. And then we'll hit analyze and see. And so now, this is just painting a scenario for you of what will work and what won't work based on what could happen, right? So if you think 33% revenue growth, 20% profit margin, 29% free cash flow margin, a PE of 30 in 5 years, and a price free cash flow of 30 in 5 years, if you want a 14% annualized return, the stock is currently overvalued over where you would buy shares at, right? Now, if revenue growth ticks down, what if they don't average? This is, again, the average over the next 5 years. What if they don't average at 33%, but they average 29%? It's only like a 10%, difference on a compound basis. Then you're looking at $109 of where you would want to buy the stock at today. Now, what if the PE trades at, say, a 26 instead of a 30? Well, then you're at $96 a share, right? So I've showed you some varying scenarios, right? If you believe the analyst consensus estimates, if you believe that they're going to be in the range of 36% revenue growth over the next 5 years, a 24% profit margin, 30% free cash flow margin, which is about what analysts are projecting, and a PE of 40, and you want a 16% annual return, you'd be a buyer of the stock all day right now. I personally think that out of all of the SaaS and cloud stocks right now, I think CrowdStrike is actually probably in the closest to one that I would want to be buying. So this is just to show you how much these have come down as the stock has traded down, like we talked about, right? In January of 2022, the next 12 months enterprise value, or we'll go price to sales, next 12 month price sales ratio was 23. Then it came down to 21 by April, 18 by July, 14 by November, 9 by December, and then it's back up to about 11 as of March 6th, right? One thing I am looking out for, though, is that they are still diluting shareholders. And so if you look, since 2020, they had 216 million shares outstanding. And by the last quarter, they had 233 million. So not crazy, but still a decent amount, and something that we want to see slow down for sure, because as a company dilutes shareholders, that makes every share that's currently outstanding, the ones that you or me, you or I can hold, makes them less valuable if they issue more and more shares. That's how that works. And so I'm not going to run out and buy CrowdStrike tomorrow. It's certainly on my radar, certainly a stock that I'm watching, and certainly an important company, a very strong company. So I understand if people own it. I just think it's a little bit overvalued right now, but definitely close on my radar. All right, as always, update, share the portfolio. We're looking at all time. So we had rallied back, and now you can see we came down. I share the portfolio all the time. We have put in since February 15th, 2022, $153,000. Current value is only $153,600, meaning we're only up about $500. We were up as much as like $20,000, I think, overall, but that's how the market works, for a return of 0.6%. Year to date, still had a strong year to date, up $26,000. We were up more, but there's been a little pullback. And as you know, if you watch this channel or subscribe to my newsletter, there's a link down in the description, investor.beehive.com, where I cover everything in detail and share charts and stuff, and you get it right in your inbox. So check that out and subscribe if you're interested in that. I've rotated out of all those expensive, overvalued cloud companies. In my opinion, they're overvalued, and into much different companies that are cash flow producing, dividend paying, out of favor companies, which are just companies I think are going to do well. And I feel safer investing in those right now than some of these expensive growth stocks. Doesn't mean I'll never invest in them again, but this is where I feel the best opportunities are. So again, I cover all these in the newsletter, but there's a portfolio if you want to take a look, and then more details always in the newsletter. Google's the largest position at $25,000. And then MPW, which has a lot of risks, but I wrote about it in the newsletter at 18,000, is about a 11% dividend right now, which is certainly at risk of being cut. So be aware of that one. Anyways, there you go. Let me know in the comments what companies you want me to evaluate, how your portfolio is doing, or just say, hey, if you want more of these videos, subscribe to the channel. Thank you for watching. Throw a like down. That helps more people find these videos, and have a great day.